Hey guys, how's it going? Today actually is going to be a financial video because, I think many of us sometimes are forced into retirement. And I just posted something on Facebook just a moment ago, just asking people, whether or not you were forced in retirement. And surprisingly, a lot of people had to retire around 55. It seems like maybe corporations, like that's the year that they want to fire people they don't want, or maybe too old. But regardless, I think I mentioned I had a situation where possibly I may have to think about it. I'm going to give it a little bit of time. My current thinking, if you've seen a couple of my other videos, is to go and do a little bit of an arbitrage scenario where I'm going to go to Vietnam and or Thailand, probably both, and just see whether or not it's possible to live out there. I also want to visit the country. It seems like it's just like a wonderful place, just warm weather, actually super hot weather, but just beautiful culture, great food. It seems like it's very healthy, and as a beach person, I would love it, I think. But regardless, I had to start thinking about, obviously the brass tacks, meaning, how does this going to look? Because if I have no income coming in, for example, I better start thinking about the retirement scenario. So I think I told you, and there's a couple other videos I've done already, about an index universal life policy, which is a life insurance policy. Now, I keep getting a lot of these in my feed on Instagram. And just so to kind of explain how an IUL works, it's really like a policy that creates cash value in the policy that you can withdraw tax-free at a certain period of time, typically like 10 years. You can take a loan against the policy, pay yourself tax-free, like you're withdrawing like a Roth, and then it goes against what's called a cash value. And it's like the loan is charged at some interest rate. I'm hoping it's like zero is what I've seen some of them, but some of them I've seen have like some positive interest rate. And then at the end of the term, say for example you pass away, if the cash value is greater than what you've already withdrawn out, that is used for long-term care, or as a death benefit that you can give to your heirs, to like your family. So they get the benefit of it. It's all tax-free. Now, my financial planner, who I think is a great guy, and he's very, very smart, he has been trying to sell me this policy. And I really started to take a look at it. There's a guy out there, Andy Panko, has a thing called the IUL experiment. Because if you look on Facebook, and I actually posted something recently about it, where I was asking people if they knew anything about it and what they thought of it. And I would say, and I don't have any, it's just a feeling on it, but it seems the majority of the responses were very negative towards it. And I think it's because people don't seem to understand, perhaps, how life insurance policy works. I know personally that I pay a lot of insurance, home, or auto. I never use my policy. And even if you use like healthcare, for example, you still got to pay like a premium every month, and then there's a deductible. So I think a lot of people have this feeling about what insurance is like in that regard. Now, I will say I had a term life insurance policy, and I just terminated it because, you're paying low premiums at the beginning because chances are you're not going to use the policy. But if you do end up using it, at the time when you possibly could die, those premiums go way up. So the way that Dave Ramsey kind of explains it, it's like you're kind of renting the policy as opposed to funding the policy. And an IUL is like a funding of a policy. Now, my financial planner tells me that many CEOs and wealthy people use IULs or life insurance policy as a mechanism for withdrawing tax-free monies. Now, I believe that, but the difference is that CEOs or whomever make millions and millions of dollars. And chances are their company is funding the IUL, not them. So I don't have any basis or fact about that, but I just do know that if you look at any CEO or any form of high-level management, they make a lot of money. I can't say that I don't make a good wage, but I don't make 15 million bucks a year. So what I did was, and this is the basis of why I wanted to do this video for you, is my financial planner gave me what's called the horse race. And what he did was he wanted to compare a Roth 401k or a Roth IRA to a one of these plans, IUL plans. So I told them, and by the way, an IUL is essentially the way pensions work. When, you know, if you're in the government sector, this is probably how you're getting a pension. It just basically you're funding into it and they invest the monies and they're giving you streams of income, but at a lesser value than what they are making in the marketplace. So I told this guy, okay, let's fund a $500,000 policy and see what that looks like. So he got this model that he gave to me demonstrating that I would run out of money by 70 or something like that. But when I looked at the numbers more closely, they really didn't make a lot of sense, at least on the Roth IRA side. I have to kind of do some more analysis on the IUL side, and I'll do a subsequent video on that. But, and I'll share this spreadsheet with you to just show you about the policy. So the way that he showed me the model was, let's say we start funding this policy now, right? Now I'm 55. So the basis is that, or the assumptions is that you're going to start taking pre-tax income, which he is stating, and that's just something I wanted to explain to you. So one of the assumptions and why he's trying to sell me this policy is because of a couple of factors that happened historically. One, if you look at the tax rates, the marginal tax rates historically in time, taxes actually have gone up. And there was a period during World War II was almost 90% of your total gross wage. And I don't know, that was a very different time of the world, but I guess if you just look at it, you know, apples to apples, it was 90% of your wage. If you go back in time, I think during the Vietnam era, the tax rate was a lot higher. It was like 38%. And then it came down to something like 20. And then I think during Obama and Bush, it started to go up to 32. Don't quote me on those numbers, but you can just look that up on either ChatGPT or Wikipedia. Regardless, the assumption here that he's saying to me, and this is probably true, is that right now, there's going to be a lot of baby boomers that are going to draw down on Medicaid and Social Security in the next coming years because they have been funding all this 401k money into Vanguard and all these other places. That money is being stored in the marketplace, but very soon they're going to start withdrawing all that money, and the government needs to tax that money. And the only way that they can refund the coffers of Medicaid and Social Security is to increase taxes. So this instrument is a way to get lower tax basis now because right now Trump just did his big beautiful bill, and tax rates are not going to change. Take the money out now to lower tax rate, and then let this thing grow tax-free, where even in the event that you're in tax prison, which is what he calls it, you're not going to be exposed to the higher tax rate of taking out your 401k in the future. And I think it's a very good assumption, if you will. And it does make a lot of sense. It's just that I don't know anybody who has one of these IULs that was successful with it, because I don't know anybody who has one of these. So regardless of that, the only thing I could do is the analysis. So in his model, he's having me fund this thing for 10 years at $47,000 a year, meaning I will withdraw $470,000 or $500,000, close to, out of my 401k, and then put it into this IUL as a cash, I guess cash premium, if you will. So the $47,000 goes against the cash balance. So, but the problem is he had this thing. One was the tax rate wasn't absolutely correct. And the second thing is that he was just using a static rate of return for the S&P, for the index against it, which was essentially the S&P 500. And if you look historically, at least the last 15, 20 years, the S&P I think has been returning around 13%. And he's using a really conservative number around 10. And I said, okay, first of all, the problem with those static numbers is it's always positive, right? It doesn't take into variability of true market returns. And I guess they call that sequence of returns. So we do have historical numbers. So I just decided, okay, the only way that I can actually see if this may work is, why don't we do something historically? Let's say, for example, during 9/11, you had to retire and you're doing this thing. What would the 10 years look like on returns on the S&P 500 if you were to do this strategy? And then flip it around from I think I did 2015 to 2025, where we had the COVID episode. What did that look like in that return? And then I kept doing that. I did 2 sequences of those. I did the 9/11 sequence for 10 years. I did the COVID sequence for 10 years. And then I did another set for the other ones. And where he had me depleting the Roth, right, to essentially convince me, I came out with a very different number. In fact, I came out ahead. So for example, I did the returns for that one with the COVID returns first. So starting at 55, those returns in the first year were 13.46, 1.25%, 12%, 21.7, negative 4.5, et cetera, et cetera. I'll show you on the screen. So if you factor in the federal, what I said was, okay, I'd like to stay within the 12% tax rate, okay? That's a little bit aggressive, but I said factor in the 12% tax rate and also factor in the New Jersey state tax, which they said was 1.75, at least that's what ChatGPT said. And then I wanted to see what those returns would look like. So after the end of 10 years, if I funded this thing $47,000 a year when I'm age 64, the balance in the account would have been $932,000. So 470, 10 years later, with all of these different sequences of returns, would have returned me $932,000. So I said, okay, let's flip it around. Let's put the COVID scenario, the COVID sequence of returns, now where I'm withdrawing the funds. So I said, okay, divide that 932, I think I said by 10. And so that comes out to essentially the same thing. I'm gonna take out $46,000 a year. And those were, that COVID return, I'm sorry, the 9/11 returns were minus 11.98, minus 22.10, 28.59, 10.82, 4.87, et cetera, et cetera. By the way, that also included the 2008 crash, because the 2008 crash, the market dropped about 40%. So if I were to factor in, let's say for example, those returns happened where when I stopped funding the Roth, I made $932,000 in the account, and I start withdrawing. At the end of the cycle, right, at age 74, I would have had $500,000 on the positive side. I wouldn't have a negative number. And then I said, okay, well, I hope I live longer than 75, right? $500,000 is great. What is that going to look like? So I flipped it around again. And at the end of that sequence, I would have made $608,000. The balance would have been $608,000, meaning I never took any money out from this thing. The principal kept on making money. So I don't know, guys. All I'm trying to say here is some of these numbers, I'm going to go back to my financial planner and kind of tell him what I found out, but some of these numbers are really wonky. And the other thing also is, it gives me a little bit of pause and concern that maybe this guy, my financial planner, isn't as great with spreadsheets as maybe I thought he was. That's the first thing I thought. The second thing is that, man, did he like hide some information to try and convince you to buy this thing? And then the third thing is like, why would the IUL be better? Quite personally, I think it makes sense to have both, to be honest with you, because if you can allocate a portion of your 401k money tax-free into an IUL and you withdraw it tax-free, and the benefit of the IUL is, I think that this is the true benefit. If you're on your deathbed and you're having to do long-term care and your children or your spouse have to take care of you, I think that's a very painful event. So at least this money provides a death benefit to them. So they have like an inheritance, if you will. Whereas even in the case of a Roth, you will have excess money, but just the way that the rule is made, the tax law is made, I don't think this money is going to just come out tax-free. It will, unless, I think you're going to have a good estate will, that where any monies can avoid the probate factor, and then all this money can get given to your heirs. I don't know the whole death tax estate thing right now. I have to look into it. My father, I was talking to my dad the other day about the home that he has, which is accreted a lot of value. But he's really planning his demise. He's 89, and naturally the money's going to go to my mother, but he has to. We have to figure out how that money doesn't get into Uncle Sam's hand, because that's money that my father worked for, right? I mean, we need to pay taxes, no doubt. I mean, he's already paying property tax, and he does pay his taxes on the income he's making from probably his 401k. I think it's a little bit too much that he has to pay a death tax, and maybe all that money's gone to the government, especially when he's got children and his wife. So I'll put these numbers up there on the board. I don't know, guys, the verdict is out. That's really what I wanted to just tell you. I don't know if these things make sense, but at least, without doing like a Monte Carlo simulation, which can run through all these different scenarios, this is telling me that his numbers are off completely, because there is no negativity, there's no negative balance in the Roth. It just keeps growing. And these are true returns, historical returns, mind you, but, somebody went through this retirement process already, right? I'm sure there's many people in 2008 who had to retire, and they experienced this scenario. So, not the exact kind of thing I'm talking about, but they experienced the market return scenario. So, I don't know. I got to double check these numbers. It seems like they're correct, but if I look at this at age 85 here, I still have $500,000. Basically, I'm break even on the whole thing. Actually, not break even. $24,000 in excess. Plus, I got to take all this money out and presumably used it for experiences, right? $47,000 at age 59 in Vietnam, or giving it to my wife so she can live. That's a lot of dough, I think, right? For not having to work. So stay tuned for the next one. I'm going to talk to the financial planner and see what he says. But I did want you to see what this was about. Thanks for watching.